Welcome to the Wisconsin Investor Podcast. I'm your host, Corey Raymond.
Oh, hey there, guy.
Each week, we bring you interviews with some of Wisconsin's top real estate investors who share their tips, tricks, and strategies that you can implement right away.
Oh, crepes.
This show is dedicated to helping Wisconsin real estate investors elevate their game. Along with interviews, I'll also dive into hot topics and solo episodes and feature experts from various real estate sectors across Wisconsin.
You betcha.
So sit back, relax, and enjoy the show. Hey everybody, welcome back to another episode. I'm really excited today because I get the opportunity to interview my good friend and one of my first mentors in real estate, Mr. Tony Broullire. Tony, what's cooking today, man?
Lots, Core. How you doing, man?
I'm doing good, man. I'm doing good. I'm excited to talk shop with you. We've talked real estate probably 1,000 times together. But I don't think we've ever recorded it on a podcast. So this is our first time.
I would say this is our most of the time we shouldn't record what we talk about. So just kidding.
This is going to be a fun conversation, I think, today.
Yeah, man.
Tony, for all the listeners out there who don't know you, our audience is mostly folks who are in Wisconsin wanting to invest or are already investing, or people who are outside of Wisconsin who are looking at potentially Wisconsin as a market to invest in. You've been in the Wisconsin market now for a long time. Why don't you just kind of start everybody back, like a brief history of who's Tony Broullire, how did you get into real estate game and your experience, and start there?
Yeah, so I started doing mortgages right out of college. So in 1997, I started doing traditional mortgage lending. I started buying rental properties in 1999, did 3 house hacks. I didn't know what the term house, never heard the term house hack for about 20 years after that, but that's what I was doing. Owner occupied a duplex, a triplex, a duplex, right off the bat with a buddy of mine, a roommate at the time. We were sitting there and he's like, how are we going to make money in this world? We were literally drinking beer, playing Nintendo. I said, well, dude, I can finance houses. You can fix them. I said, let's buy some rentals,
Nice.
And that's kind of how it started.
Nice.
Fast forward a couple of years, did some flips with I got 2 brothers in the area. We did some flips. We have a construction background. I have an uncle that we worked construction with in high school, a little bit in college.
Okay.
So I can swing a hammer if need be. I don't like to if I don't have
to.
I'm
learning something about it. I'm just kidding. We did a mission trip in Mexico together, and you looked like you knew what you were doing. Much more than me getting kicked off the trust work.
I know a few things. But and then fast forward to 2012, I was sitting there and I called my 2 brothers up and I said, hey, we're going to buy some rental properties. I said, we're going to have a property manager take care of these properties so we don't have to dink around with the day-to-day stuff. And we bought 52 properties in the next really 2.5 years, from 2012 to 2015, almost 3 years maybe.
Wow.
And we didn't come from money, Corey. God bless you if you did. Those listening, it makes real estate easier, but not impossible if you don't. I mean, we grew up in Niagara, Wisconsin, 1,100 square foot house, 6 of us, 1 bathroom, right?
Yeah.
I mean, I shared an underwear drawer with my brothers. So yeah, pretty gross. But is that too much for the podcast? I don't know.
Nope. There's no holds barred here.
Yeah. Okay. All right. Yeah. I wasn't sure. So, but yeah, so we bought all these properties. So we had to get very creative with how we utilize equity, partners. We found we had a ice fishing buddy. He had $100,000 sitting in his checking account. We parlayed that into 11 houses. I mean, we used the same money over and over again, partnering with the banks. I talked to 22 different banks, Corey, before I found a bank that did what I wanted them to do.
Yeah.
So I mean, 22. I'm not exaggerating. I went to every bank pretty much in Northeast Wisconsin and some outside, to find banks that would refinance us as quickly as we needed to, so we could buy as many properties as we wanted to.
Yeah.
Completely different market at that point. Foreclosures were rampant. We could go to a realtor, pick up, say, hey, we want to look at these 10 properties. They're all needed work. We'd put offers in on 6 and get accepted offers on 2. I mean, it was completely different market than what it is now.
Yeah.
Our problem was we didn't have money. I couldn't, and hard to find any money. I would have loved to have had a me then, now back then that has this pool of money now that I can pull from. So hard money lender.
Update the audience now. What do you do now, Tony?
Yeah. So fast forward a little bit, even more than now to this time, is that, because of, long story, very, very short, I started pulling money together to lend to other real estate investors. Rolled over a 401k into a self-directed IRA, which we could talk about some other time, and started lending that out. I became the bank, a very, very small bank, and started a fund where people invest with me, and then I take those monies. They sign a subscription agreement. I take those monies and then lend that out to real estate investors as a first mortgage lien holder on the investment property.
Yep.
So,
Awesome.
and I'll fund the whole purchase price, the rehab, all that fun stuff, as long as the loan after repair value is low enough.
That's
so
awesome. That's awesome.
Pretty slick. So yeah, so that's what I do full time basically now.
Let's go back to the original properties you bought with your buddy, right? How long did you keep those properties?
Yeah, good question. 3 of those properties have been raised. Not since I had them, or since I've had them. I didn't have them when they were, but
wow.
We were buying all in the D neighborhoods in Green Bay. Okay. Really learned a lot of what not to do, okay. What I didn't want to really deal with a whole lot. But I held one of those properties until 2 years ago.
Oh, wow.
So I bought it in 2000 and sold it in 2021 or 2022 or something. So
okay.
I held one of them that long, and I held it that long, Corey, because it was I wanted to make money on it, and it was just a terrible property. And I knew that I had to get some appreciation eventually on it, which I did, and sold it, made I think $10,000 finally.
Took 21 years to get your 10 Gs.
Yeah. But I didn't lose money on it, man. So that was the key.
Yeah. Well, I remember like when I was getting into this, you were one of my first stops of like, whenever I'd have a fear, I'd be like, Tony, what about this? And you're like, here's my answer. What about this? And one of those was like, what if I make a bad purchase? And then what'd you say to that?
Time, man. Hold it. Let it keep it as a rental, cash flow as much as you can, and hold it till it appreciates and sell the bad boy. Don't lose money on it. Yeah. You know, time cures a lot of wounds in real estate. A lot of bad mistakes. You can make them okay.
If you can weather a storm and just hang on and get through it.
Yep.
Typically on the backside, you're going to end up okay if you hold it long enough, right?
Yeah. Typically, like to have multiple exits. Now I changed a little bit. I have multiple exit strategies going in. So like if I have to get out, I don't have to wait 21 years.
That's a good lesson. Good lesson right there, folks listening. Take that one from a guy who's been in the game for 25 years here. Talk about partnerships with me, Tony, because I've interviewed some other people who are in partnerships and it's working well. What are some of the lessons you've learned, because you've had a couple partnerships now on long-term holds? You and I have done some partnerships on some flips and things like that. Short-term, pretty easy, a JV agreement together between the two of us, and it works out great. Talk about like, what are some do's and don'ts of lessons you've learned of partnering in the long run, especially with family?
Yeah, I would recommend a couple things real quick on that. Number one is do a short-term one first. See how you guys work together. Everyone works together. You do not have to set up an LLC where everyone's involved and you got all that. You can do a joint venture agreement or have just a written agreement between the two of you, depending on how well you know that person. Do a deal together. See if this is going to even work. Yep. You don't need to be married forever, on these things. Yeah. The other thing, though, is if you do decide, hey, this looks like it's going to be a good partner for me, the LLC agreement does a lot of stuff, but it does the big stuff. If you get divorced, if someone dies, that type of things. What it does not really a good job on typically is it doesn't, even in the operating agreement of that LLC, it doesn't do the day-to-day stuff. Who's going to deal with the bank, setting up the bank account? Who's going to deal with the insurance agent? Who's going to deal with the realtor when you go to sell it or buy the property? Who's going to phone calls from anybody when they're looking at rent or whatever? Who's gonna manage property? Who's gonna fix the property? Those day-to-day things, Corey, are most of the time not in that agreement.
Yeah,
most of the time.
Yeah.
So I highly, especially any partner, sit down, take an hour, grab some coffee, grab a beer, preferably grab the beers after you get the agreement, but write down, hey, Corey, you're gonna do this. You're gonna do X, Y, Z. Tony, you're gonna do X, F, T, Q, and P, right? Yeah. And then write it all down. Both of you sign it. You both have that copy. So when you wake up, Corey, 4 months from now and say, Tony's not carrying his weight. You can go through that list. Instead of getting mad, just go, hey, we got to sit down and have another meeting. Go through the list and shift things around. So you're both doing what you say you're going to do.
Yep.
Because I always tell people, you don't want to ruin Christmas. Okay. But you don't want to ruin a relationship, especially a family relationship or something stupid like money in real estate. And I see it happen all the time, unfortunately.
Yep.
And it's because people don't set it up correctly.
Yep.
Okay. And you're not going to know everything. You're not going to see everything. I get that. That's why you have to adjust it.
Yep.
But you can adjust it. You both can sign. Then you can wake up when you have that day when you wake up and you're like, man, Corey's not holding his weight, or some sort of lifestyle thing change. You know, Corey just had 3 kids. He can't do what he said he was going to do anymore. All right. Then maybe it's time to get out. That's fine too.
Yeah.
It's not, again, you're not married. You can totally sell those or buy that other person out or whatever.
Mm-hmm.
Or shift the ownership too. Say, hey, Corey, you're only going to do 20% of the work now. Okay. You get 20% of the value going forward, or 20% of the profits going forward, or whatever.
Yeah.
Those types of things.
Yeah.
But it's that communication up front, Core.
I was just going to say, I think the biggest nugget that I took away from that is it's all up front. So if you can try to forecast like all of the potential worst case scenarios and then have a contingency plan in place for all of those that you all agree to, then it's not so harsh coming in when, you know, I got 3 kids and I'm like trying to make ends meet. And you're coming to me like, dude, now you got to take 20%, man. Like if we agreed on that ahead of time, it's like, yeah, totally, dude. Yeah, I'm not doing it. I don't have the time. Yep, we talked about it.
Yep,
I get it.
And just have those conversations. You're not gonna ever be able to cover everything that could or is going to happen. Mm-hmm. But if you have the day-to-day stuff worked out, you should be all right.
Yeah,
typically. And that's what I see.
Yeah, we see that with our employees too. It's like if we don't give them clear expectations, there sometimes can be frustration on our end. Like, why aren't they doing this or why aren't they doing that?
Right.
And then they're over there like, well, I don't even know what I'm supposed to be doing. So I'm just going to do this because I think that's what I'm supposed to do. Well, I'm not going to do anything because I don't know what I'm supposed to do. And so in a partnership, that could easily be the same scenario. Like, well, they'll take care of it. Or
expectation setting is really good actually for marriages as well. So just throwing that out
there. we could go down that path, I'm sure today, but I don't know if that's as relevant in this case. No, that's really, really good information. What are you seeing on the lending side of things right now? What are the big trends that are happening? What are you seeing from the investors you're lending to as far as here in Wisconsin?
Well, we are seeing actually there's still business being done. We're gonna have probably our biggest lending year. Well, we'll have our biggest lending year ever. We've already closed more loans this year than we closed all of last year.
Holy
and part of the reason we expand our territory a little bit, but part of the reason too is we're educating people on how to do this stuff. Mm-hmm. And there's right ways to invest and there's wrong ways to invest, and helping to educate people on that is huge. The other thing too is now there's DSCR loans, debt service coverage ratio loans, mm-hmm. where for investors, where we don't even need, don't even need your income. It's all based off the property itself, mm-hmm. and you can do them in an LLC or in your personal name. So I mean, that's a game changer. Those loans haven't been around. They were around years ago. Now they went away, and now they're back. And they're a game changer for an investor.
Yeah,
because you can get out. You can literally get out of a private money loan, or you can refinance on a 30-year fixed type mortgage without showing any of your income.
That's crazy.
So based on that property, cash flowing is the key.
Okay. What do you think is the cause of that? Why are these coming back? Any indication from what you hear, or why these loans are making their way back into mainstream?
Yeah. I mean, before it used to be for owner occupied and stuff like that. There's no income, no asset loans. I mean, that's part of the reason 2008 was some of these ridiculous loans that were out there. But for investors, they're looking at it like a business. Okay. You're taking in $1,500 in rent, and your principal, interest, taxes, and insurance is $1,100. Okay, that makes sense, right? Mm-hmm. You should be able to cash flow on that,
right?
So. Yep. They're looking at it as they should, as a bit. Hey, this particular property is a business. Right. Ultimately.
Okay.
In essence. I mean, to dumb it down completely. But
so that's giving access to a lot more people then that otherwise maybe wouldn't have that access to their credit or their income.
Yes. It's giving people multiple exit strategies, Corey. So meaning, hey, I can either flip this property, I can sell it, flip it, or if that flip doesn't work, I can keep it as a rental and cash flow this thing as a long-term rental, because I can do that DSCR loan.
Are they doing that DSCR loan up front? Or are they typically refinancing into it?
You can do them up front if you have money down, right? Okay. If you have a turnkey property or property that you can just walk into, rent it out because everything's fixed up,
Okay.
Yeah, you could do it right off the bat. Typically, you're looking at least 20% down in that
Okay.
scenario with the DSCR loan. Otherwise, what people will use private money or hard money lending for is they'll be able to get the mortgage or get the purchase, maybe some of the rehab or all the rehab costs in the initial hard money loan when they buy the property, get that property fixed up, force some equity and do a refinance then, and oftentimes have none of their own money out of that into that deal because the refinance goes off the new appraised value based off the work that you did on it.
Yeah, that's the
You know,
key. Recycle then, right?
you're forcing that equity by doing you're forcing equity building up you're forcing the building of the equity because of the rehab that you're doing, and you know that going in or have a good idea what that's going to be going in.
Yeah,
So
that's great.
yep.
What areas do you guys lend in? Are you all over Wisconsin now?
Yep. Yeah.
All over. Okay.
Yeah, we're all over Wisconsin. Yep.
Okay. Um, as far as areas go that you're seeing, are there any particular areas at this time that you're seeing where the market's really scooting up? And are there some areas that are maybe not as hot as maybe they once were a year or two ago?
It's a really good question. I mean, again, where our volume has been substantially up, and partially because we've sort of moved down in the Milwaukee area a little bit more as well. But we have not. I haven't really seen it slow down in the Green Bay Fox Valley regions either. And thanks to wholesalers like yourself that are finding deals, Core. You know, those people are able to go to your wholesaler, get that deal at that below market with the rehab that's needed to force the equity. There's still deals out there. You just got to find them different ways now. You can't just go to your realtor anymore and say, hey, I want to look at 10 houses and put offers in on 6 and buy 2. It doesn't happen anymore.
Yeah.
You know, finding deals on the MLS, and there are people that are still finding deals that are, go to a realtor and finding deals on the normal way.
Yeah.
I'll put quotes around that. Where they're going to their realtor and saying, hey, find me something, but those are few and far between.
Yeah.
It's people that are going to WDP and getting on their list, finding that deal,
find your dealer.
And then
find your deal,
rehabbing
dealer.
that property and either flipping it or refinancing at that point.
So everything you're seeing in Wisconsin right now at the time we're recording this, which is July of 2024, market's doing great. There's no indication that we're seeing any kind of slowdown whatsoever.
No, and I haven't seen that. I mean, you're seeing it maybe a little bit in the traditional realm where because there's just lack of supply. But these houses, there's still people beating up houses, Corey. There's still people that need to get out of their houses and can't fix them up. Yep. As you're well aware.
Yeah.
And though that's not slowed down, so that piece of it hasn't slowed down at all.
Yeah.
During this, the caveat now, and this is kind of evened itself out a little bit. I've seen is that when rates shot up there, to 7, 8, whatever, it's harder to cash flow. But we've also seen rents go up as well. So you got to really pay attention and run your numbers.
Yeah.
Yeah. Did the rents go up high enough to cover the new rate? And it's really kind of it evens itself out eventually.
Yeah.
And I think we're starting to see some of that now too, where and it's not every deal by any stretch of the imagination, but I mean, there's definitely deals out there, but you just got to run your numbers and stick to your numbers.
Well, I think what's important about that, and I preach this all the time, is like know what's your goal? What are you trying to accomplish? Because for some people, if they need cash flow to live off of, or they need some kind of rate of return on their, on their down payment and, rehab and all that stuff, it's going to be maybe a little more difficult with interest rates high. But if you're in this for the long haul and you go, okay, 7-8% rate is what it's at currently, probably depending on what banks you're talking to. And you can break even on it for now, but you got yourself some equity in this thing. Tenants are paying that debt down still every month. That thing's still appreciating every month. And when rates go back down to 5% or whatever they end up settling in at for a while, I mean, now rents have probably still continued to rise, maybe not as high as the market has appreciated, but they're still going to rise. And then you go refinance that thing at that point, and now you're really cash flowing, and now you got all this equity. And the realized gain before, I think, like in your era, what you're talking about in 2012 was you could probably rent these things and they were cash flowing day one, and it was pretty easy peasy. And well, now it might be the reward is a couple of years down the road for you if you're patient and you're willing to just add assets to your balance sheet.
Yeah, I would say this too, Corey, is that it really depends on what your situation is, right? Yes, if you're looking at pure cash flow, it might be a little bit more difficult potentially. You just got to get that little bit better deal, whatever. Maybe you're in a different type of market. potentially. I tell people all the time, I'm like, hey, in the beginning, this is a marathon, not a sprint, right? In the beginning, do not take money. So if you're making, say, $500 and two doors or whatever, and you're like, all right, I got this extra $500, I'm gonna go buy a car. That extra $500, that's foolish.
Yes.
Take that $500, put it in your account, get that buffer built up high enough so that you feel comfortable and can weather any storm. Roof goes bad, you got to replace it. Fine, I take it out of there. I have a tenant that's not in there for 3 months. Fine, no big deal. I can take it out of there. You can sleep better at night knowing that that buffer is there. Put that money in there until you have a buffer big enough, and that's maybe a little bit different for everybody. But I personally want a 6 month buffer in there so that I can weather whatever's happening.
Yeah.
So keep that in mind.
Yeah, I agree with that 100%. I think the one struggle I see with people is they think they need to have that money right out of the gates in the bank account, or they'll sit there, then I can't buy the deal. And yes, you need to have cash and you need to have access to cash, but does it have to come from this exact prop? It might just take a while, like we were saying, to start building up the coffers a little bit and fill the silo, so to speak, of some money.
It's for everyone I talk to. I'm like, hey, do you have equity in your house? You should have a HELOC on that thing. People that have equity in their house and like, well, I don't want to risk my property. Well, yes, if you're an idiot about use it and take it and go buy a Lamborghini with it, yes, it's a depreciating asset typically. Yeah, problem. If you're going to use that equity though as either a buffer or use it as be your own bank, pay yourself back like you would pay me back, as the hard money, you can make money on that equity. That's when this becomes really, really fun. Be your own bank, and then keep some of it as that buffer, like you're talking about. So you have that $20,000 buffer, $10,000 buffer, whatever you feel comfortable with, in your HELOC that you can pull out if need be, if something does go a little sideways. And that way, you don't have to wait until you don't have to be scared because it's sitting there for you.
Right. It's like your emergency fund that you already paid into your house, but you just don't have access to it until you get that HELOC going.
Correct. Get the HELOC. Get the HELOC
sitting in the house. I think I just heard of a story. I was telling another guy that's interested in getting into real estate investing last week, and we were talking in shop, and we asked, hey, do you get some equity in your house? We went through this whole conversation, and I said, well, you might want to think about getting a HELOC, all these reasons we just described. And he brought up one of his buddies who had a gambling problem and took a HELOC out and went and bought crypto with it. And you can imagine how that worked out. Didn't go so well. Volatile asset like that. Probably not a good idea to invest your HELOC. So we use it as just like what you described, a recycling. When we deploy it, we refinance that property as quickly as we can. We pay the HELOC back down to zero. Do it again. Do it as many times as we can. We just recycle it. And if we don't use it, it's great. We have access to it. If something crazy comes up, we're not wondering where's the money going to come from and how we're going to survive and feed the kids.
And then you might, if it's your first couple, if you want to do sometimes what people do, and I don't hate this strategy either, is maybe do a couple flips, build that buffer up right off the bat. Your first one, you make 10, 15, 20, 40, 50, well, hopefully 100,000, whatever. Yeah. It's not HGTV here, people. So you're not gonna make 100,000 every time. But that being said, though, maybe you make that 10,000 or 15 or 20,000 in that house. And maybe do that a couple times and you keep that as your buffer. Make sure and put money aside for taxes. I see people do that all the time where they're like, hey, I just got $10,000 and they don't put money aside for taxes. Do that. Put that aside. Make sure you have that. That can be a big, well, holy crap moment for you when you get your tax returns and you're like, hey, I owe 30,000 in whatever, you don't have it. But you can do a couple flips, and I see people do that all the time. They'll do a couple flips. And then if the flip doesn't work, they know it's still going to cash flow as a long term, and you just keep it. And the next one maybe you do as a flip.
Right.
It's that multiple exit strategy piece that is so important.
Yeah. Don't buy an Airbnb and your only exit strategy is overpaying for it, and Airbnb is the only thing, and then the laws change, and now you're screwed.
Yeah.
We saw a lot around Lambo with other people. They were really excited around Lambo to buy properties, and they were paying whatever the seller wanted and over that. And the only exit strategy was Airbnb. Yeah. And when the town of Ashwaubenon or Village or whatever changed the rules, there was a big flood of inventory in that neck of the woods that was all overpriced, and people were losing their shit.
And that's happening all over. So you really have to pay attention to that. And I'm not saying you shouldn't do Airbnbs. I still have some, and I do love them. That being said, though, it still better be able to cash flows long term. Yeah. In my humble opinion.
Or what I like to do when I buy my Airbnbs, if they're single families, is I better have enough equity in that thing so that I can sell it. I could sell it as to a retail buyer. And if I
another exit strategy, It can be, it absolutely can be equity as well.
Yeah.
You got to watch that a little bit when you're in, if you're going to go into Florida, some of the coast, if you're going to go in there, because the markets can be much more fluctuation, in the market.
Yeah.
Where, I have equity today, but 3 months from now, something shifts and you don't.
Yeah.
And so that can be a problem, but make sure you have enough.
That's why we love investing in Wisconsin, man. It's very steady Eddie. Not a whole lot of ups, not a whole lot of downs, just even keel. Just
for the most part. Yep.
We are the Berkshire Hathaway of real estate investing here in Wisconsin. Just steady Eddie.
I know nothing about Berkshire Hathaway, but I'll trust you on
Warren Buffett. You know Warren Buffett?
I've heard of him. Yes.
Yeah, he's a steady Eddie, boring guy.
There you go.
Just does his boring investments and pulls away. Another thing with HELOCs, before we move on from that, something that we've done before is you can shop that around just as well. And we look for any kind of HELOC on a primary that's going to be up to 90% of our home value, at least. That's kind of the minimum we want to shoot for. And then no closing costs. That's usually something else they'll do on a primary. And then sometimes they'll offer introductory rates. So we had a bank 2 years ago, I think it was 3 years ago, maybe. They offered us 2% for a year on our HELOC. And I was like, yes, let's do that. And then I gave it to you and you lended out my money for me. And I just played bank and I made a spread on the bank's money to what my HELOC was. And it was great. I was making money on money that otherwise was just going to sit dead in my house.
Yeah.
I didn't really have to do anything. I just had to call you and say, hey, I got $100,000. Where can you put this to work? Boom. You took it and I made a spread.
You arbitrage that. It's a word I learned. I learned that word 3 years ago and I like to use it. Makes me sound smart-ish.
But that's something you can look at too. A lot of these banks will have introductory rates for a certain period of time on these HELOCs, which oftentimes will be cheaper on your primary residence than what you could get if you went to your commercial lender or especially to a hard money lender or private lender. So that's something else to be aware of out there for you guys. A little quick tip.
And once you start building up your portfolio, if you start to gain equity or force equity because you did a rehab, there are potentially do HELOCs on your investment properties as well. You can do blanket loans. I call them blanket loans or gap or bridge loans or blanket loans. I'm drawing a blank, but where you can buy a property, use the equity in the other one so you don't have to put any money in. I mean, there's different fun things that you can do once you start having enough properties with equity in them. Don't want to get too much into that today because it can get a little bit complex, but
key is you got to have properties first before you can start playing chess.
Yes.
Yeah. That's the key. So I see a lot of times people sit on their hands and analyze real estate for 3-4 years, waiting for the next crash. You know, what is your advice to people that are waiting for the next crash, Tony?
No. Does the deal pencil out? Do your numbers work now? Do your numbers work? Does it cash flow right now? Do you have some equity in it right now? If it cash flows right now and you have equity in it right now, what are you doing? Buy the property. Don't wait. Don't wait. I mean, property values have not gone this way. They did a little bit in 2008, 2009, right? Fine. Those people who panicked and sold their properties lost their butts. Those people who just held on to their properties during 2008, 2009, like myself, rents went up during that time. I actually made more money during then. My point is if they cash flow now and there's some equity in them, buy them. Don't wait.
Yeah, I did a YouTube video. If you guys go to my channel, my personal channel, it's out there. And I used some data from a guy who came into one of our masterminds, a big mortgage guru dude. And he had this amazing chart that showed the last 75 years of the housing market. And of the last 75 years, I believe the number is the real estate market has won 68 of those 75 years with positive appreciation. So there was only a 4-year gap between 08 to 2012 where nationally housing prices were negative those 4 years. And then 3 other times in 75 years other than 08. I mean, that's a pretty good bet. That's a pretty safe bet that you're going to get appreciation every year. And I beat the drum on this podcast with people about the wealth cone, as I call it. And it's, you buy today and there's not much spread, but each year that you get the double effect of the market appreciating and the tenant paying your debt. And it just grows and grows and grows and grows and grows. And the longer you hold that thing, the bigger that spread becomes and the wealthier you get.
Yes. Super. Yeah. It's super important. So just again, if you're cash flowing right now at 7% or whatever the rate's going to be, okay, you're probably going to be fine 5 years from now, would be my guess.
Yeah, exactly.
So
Awesome. Well, Tony, I want to wrap this up. I know you got a lot of things going on. If somebody wanted to get some funding from you guys or talk about funding, what's the best way for them to go about getting in contact with you guys at Good Faith Funding?
yeah, you can see we try to make things pretty simple. If you go to my website, it's goodfaithfund.com. And then you hit the start here button. I have two big buttons in the middle of the screen. One of them start here and one of them is borrower portal. Hit start here button. There's a 3-minute and 18-second video that you can watch that explains exactly what we do, the hard money process for us. And then below that, you can just set up a Zoom call with me.
Awesome.
I meet with every single one of my borrowers, and we'll spend some time with you, talk to you about, hey, what are your goals? What are you looking at? And then I have a bunch of resources and stuff too that I can send over to you afterwards. And just go to the start here button, man.
Okay, I said I was going to be the end of it, but I have a question for you now. Okay. What are some things that you look for in a borrower? What are important things when you're going to evaluate whether or not your company is going to fund somebody?
Yeah, that's a great question. So when I'm looking at, I've done loans for people who have never bought a house before, right? And I've done loans with people who've done 100 houses before. But what I'm looking at is, hey, when you come to this meeting, you're really trying to get to know me a little bit, but I'm also trying to get to know you. This is like an interview, right? Mm-hmm. You're asking me to give you hundreds of thousands of dollars that I have gathered from family and friends and friends of friends for the last 10 years. This money is very, very important to me because this is retirement income and things from people that I care about, right? Yeah. So I want you to be prepared. When I have a couple questions that I ask you to, answer so you can set up the Zoom call, right?
Yeah.
I have a couple questions. Have correct spelling on it. Mm. I have one guy spelled his name wrong. I'm like, dude, it's not like you have to be super professional with me. I'm not, but be prepared. Mm-hmm. Do a little bit of research about what you're trying to accomplish with your business. Okay. That's number one. Is just, hey, be prepared. Do you know what you want with your business? Yep. What are you looking to accomplish? And then we can talk about that a little bit more. The other thing too is, I don't require credit reports or anything like that for what I do. That being said, I do want multiple exit strategies. So one of the things that I require, it's a little bit different than a lot of lenders out there, a lot of hard money, private money guys, is I want you to be pre-approved for the end financing, meaning for that long-term financing to be able to pay me off. Mm-hmm. I want that exit strategy to be set up. So, hey, get your credit scores where they need to be. Mm-hmm. And I can help. I have tools and things. There are people that have tools that can help with that stuff. But let's make sure that you're ready to rock and roll, credit wise too, because it's important. You can't have filed bankruptcy yesterday and then say, hey, I want to now start my real estate business. Yeah. That doesn't mean that you can't partner with somebody who has good. So there's ways around that.
Yep.
Yeah, there's ways around that. I've had people that have had some credit issues and things, but they had the knowledge and the wherewithal to be able to do the real estate piece, and they partner with someone who has good credit. So we have that a second exit strategy. Awesome. So there's ways around that. Those are things that we can talk about. But point is that hey, be prepared.
Yeah.
Do listen to a podcast now and again. Do some research. Read Rich Dad Poor Dad, whatever you need to do. Yeah. Which I should read someday. I had never read it, so
it's still fascinating to me that you have never read that.
No, I got to read it someday. I will. Yeah, I promise you. Yeah. But be prepared for that meeting. And when you're answering those questions and things, do it like this is an applicant. Like, it's important.
Yeah.
It's not important to you, and if your spelling's off, or if I ask, hey, why do you want to do real estate? You're like, because I want to make money. Well, we all want to make. I get it, right?
Yeah.
But why do you want to do real estate? Put some thought to this.
Yeah. Sell you on it. It's just like you said, a job interview.
Yes.
I've had some borrowers before that, with banks in particular, there's a banker they would reach out to who we recommended as a solid option for, commercial loans or whatever. And the banker didn't get back to him or whatever. And it's like, they're like, well, forget this bank. And I'm like, well, yes, they should have responded to you, but also they have the money and you need the money. So just like a job interview, maybe they're testing you to see if how bad do you want the money? Like,
you are the one that
needs the funds, not the other way around.
22 banks, Corey, I talked to. 22 banks. Do you think I had to badger a couple of them to get a meeting with them? You're darn right I did.
Yeah.
But 22 banks.
It's the deal, is what they say, right?
So, yeah, don't be too squeaky. That annoys me too. But whatever.
Yeah. Well, you get back to people relatively quickly, so you shouldn't have that issue. Yes,
Thank you, I appreciate that.
You're pretty diligent about your responses. So
I try to.
No, I think that's a great point. I'm glad that you brought that up, Tony, because that doesn't just go for meeting with you. That goes for meeting with any lender.
Yes.
Anybody you're going to talk to about financing, whether that's friends and family. It's probably more important in friends and family that you're prepared, but also commercial lenders, all these things. Let me ask you one other thing about the end financing for you. Does DSCR qualify for what your requirement on the end financing?
Absolutely.
You can 100%. DSCR loan on it. You don't have to get the traditional 30-year fixed box.
Nope. Yeah, DSCR. Yeah, absolutely. I mean, okay. And again, you're running your numbers based on those DSCR numbers to make sure that, because DSCR typically is a little bit higher interest rates, you're going to run your numbers based off that. If you can get a little bit better financing or whatever, that's great. But put your buffers in there a little bit too when you're running your numbers. Cool. So I'd rather be pleasantly surprised than freaking out because I was pie in the eye and I wanted a deal so bad I made the numbers work. The numbers either work or they don't.
Yeah,
it's numbers. Don't get emotional.
Don't fudge your numbers.
Don't fudge your numbers. Don't get emotional. Don't fall in love with any houses. It's just a house, okay?
Yeah.
Fall in love with your numbers and stick to them.
Yes. Yeah. We could probably keep this thing going for another 20 minutes on that topic alone. We'll save that. We'll probably have you back on, I'm sure, at some other point in the future here, Tony. So thanks for being on the podcast, guys. Thanks for listening. If you like it, subscribe, share with your buddies. The more people we get to listen to this, the more guests we can get on here and the more value we can bring to you guys. So, if you guys are looking for off-market deals, head to wisconsindiscountproperties.com, sign up for the buyers list. If you're looking for funding, head out to Tony's website, goodfaithfund.com, and click the Start Here button. So with that, Tony, thanks for being on, man.
Hey, thanks, Carl. Great seeing you, man.
All right. We'll see you guys on the next episode. Hey, this has been another episode of the Wisconsin Investor. Thanks for tuning in. If you got some value out of the show, please go like, rate, subscribe, share, do all that fun stuff. And if you're new to investing in Wisconsin and you want to have a conversation with somebody from our team, we would love to have that conversation with you. To do that, just go to our website, wisconsindiscountproperties.com, hit the contact us form, put a little bit of your info in there, and somebody from our team will reach out and have a conversation, hopefully help you start moving forward in your investing journey here in Wisconsin. Thanks for tuning in. We'll see you on the next episode.